we would like to take permission for recording. So yeah, the session will be recorded. Yeah. So AV team, yeah. Yes. So so yeah, since the recording has started, yeah. Uh, yeah. Hi, good evening, everyone. My name is Kunal Jain, and today I am the host for the today's session. It gives me immense pleasure to welcome Mr. Rajiv and my court members and my dear friends. A very warm welcome to the guest session on the mechanics of investing, hosted by ISB PGP Pro, Hyderabad class of 2022. I would like to thank Mr. Rajeev Agrawal for taking out time on a weekend to speak with us to provide us the knowledge. Let me start by giving a brief introduction about our speaker. Mr. Rajeev Agrawal is a proud alumnus of IIT Bombay and IIM Calcutta. He is the founder of DoorDarshi Advisors LLC, a US-based firm that is a general partner to DoorDarshi India Fund. DoorDarshi Fund is a hedge fund based in the US and focus on investing in Indian equities. In his previous roles, he has been also the managing director and CTO of IHS Mark IT, a publicly traded company that delivers next generation information, analytics, and solutions to customers in business, finance, and the government, improving their operational efficiency and providing deep insights that lead to well-informed and confident decisions. Mr. Rajiv regularly speaks about his investment philosophy, value investing, and India's growth story with the students of IIM Ahmedabad, Bangalore, Calcutta, and different IITs. Before I hand it over to you, Mr. Rajiv, I will share an overview about the PGP Pro program. Ours is a 18-month-long executive MBA program for working professionals. Most of us are at mid-level positions in the corporate and have an average experience of 10 years. And we are looking forward to new roles and getting into senior management positions. Also, I would like to introduce my co-host, Mr. Adil and Rajit, who will be moderating the sessions. And I would like to hand over to Adil. So Adil, yeah.
Thank you for the warm welcome, Kunal. We are truly fortunate to have Mr. Rajiv with us here today. So Mr. Rajiv mentioned that he would like to divide the session into two halves. That's the regular way he delivers his lecture at IIMs at the IITs. So in the first half, he'll be speaking about the investing, the basics and the investment returns, where they come from, and his philosophy of how he approaches a particular investment. And there'll be a certain pause where we can ask him question and answers based on that. And in the second half, he's going to show us a few case studies where he's going to say how he approaches various investment philosophies. And after that, we can have a further question and answer session. So please put your questions in the chat and we can forward it over to Mr. Rajiv. Thank you.
So Adil, should I start or
yes,
we
Mr.
have?
Rajiv.
Okay, great.
Please,
so I will share the screen, right? Are you able to see my screen?
Yes, we can see your screen, sir.
Okay, wonderful. So thanks a lot, Kunal, and thanks, Adil, for organizing this session on investing. It is wonderful to be talking to some of the best minds of India today. When Adil reached out to me for this session, I was immediately very interested, as he will attest. I have been very passionate about investing, and I believe that investing intelligently can transform one's financial well-being. And that is what we will talk about today. Now, it is important to point out that there is no one right way to invest. There are many different ways, and there are many ways to achieving good success through investing. And what I am about to present is an approach that has worked well for us and that aligns with who I am. And that is what we are going to focus on. So with that, let's jump into the presentation. I think Kunal covered my profile So that's great. The one thing I want to do is to break down my profile into two halves, right? The first is the entrepreneurial journey, which I have been on since 2016. And so there I have sort of been initially an independent investor, and then setting up a fund, which is the DoorDarshi India Fund that Kunal talked about. So the fund is a Delaware US listed fund or US based fund and invests in Indian equities. I also am a top ranked analyst on SumZero, and we will spend some time looking at some of those case studies, which has allowed me to get there. I think the corporate journey was covered well. Just briefly, IHS Market Managing Director and CTO when I came back to India, and that is where my love affair with Indian equities started. Prior to that, I was in New York at Goldman Sachs, where I was heading risk technology for prime brokerage and execution and clearing business. Prior to that, I was at Bank of America, where I was doing market risk technology, and we were managing market risk for the proprietary fund or the proprietary book of the firm. And then similar thing at JP Morgan. I think educationally, I am a CFA charter holder with an MBA from IIM Calcutta and a BTech from IIT Bombay. So as we had other layout, we are breaking this presentation into two halves, right? The first half, we will talk about the approach. What is our approach to investing? And how does DoorDarshi India Fund go about investing? In the second half, what we will do is we will break down some of these approaches and how they actually apply to the real world. And the real world here are the case studies that I've presented on SumZero. And that will allow the participants to not just understand the theory, which is so much easier, than to apply it in practice, which is so much harder, right? And that is what this session is going to be all about. It is going to be about application of investing principles and how we go about it, how we think about it. One of the things I like about this presentation is when there are a lot of questions, because questions are the ways to answers. And if there are a lot of questions, I think that allows me to understand that people are engaged, the participants are engaged, and it helps me broaden my own thinking. So I will encourage people to ask questions after the first portion is over, and as well as a lot more questions with the case studies when the second part is over as well, right? So with that, let's jump into the presentation for today. So first question, what is investing, right? I think if we are talking about investing, let's get the basics right. So first thing is investing is not savings. And many people sometimes even confuse that basic issue, right? Savings is money that you earn, but you don't spend. So that is savings. And a portion of the savings should always be kept for your emergency reserve. You might have a new need that might come up, and you don't want to at that point be running from here to there. You want to have the money available so that you can take care of that emergency. And then the remaining should be invested based on your own needs and abilities. So clearly right here, you see that investing is very personalized. It depends on your needs and on your abilities and your temperament. So it is going to be very much dependent on the individual circumstances. Now, Warren Buffett has laid out a very simple definition of investing, which I will point out here, which is that investing is often described as a process of laying out money now in the expectation of receiving more money in the future. And so when you look at this definition, you can see that the investing ultimately has to deliver real returns, which means after inflation and after taxes. That is the only way you will have a better lifestyle, because your investments have grown over time. And so unless you have an expectation of good returns, of receiving more money than what you have put in, you should not really be investing, or that is not really investing. Our definition of investing is even simpler. Kunal mentioned that many of the participants are in the mid-career, right? And most of the participants, if you ask them, why are they doing what they're doing? It is because they're working for money, right? And if you take away that need to earn money, maybe they will do something different, right? And that was the case for me for a very long time. And so the purpose of investing is to move from working for money to have money work for you. Because if you invest properly, that money will grow over time, and that will allow you to do what you want to do. So the ideal situation is where you make money while you sleep, or you enjoy a siesta in the park, right? So that is what really investing is, and that is how we think about investing when we have investors investing with us. So I've given what is investing from our perspective. Now let's look at it. Why is it important? So the first thing is, when you are early in your career, you have a very high amount of human capital, right? And human capital here is your ability to earn and save money over your life, right? So it will be highest when you're just starting, and gradually your human capital comes down and your financial capital goes up. So as is depicted in this chart here. So what is important to note is that the financial capital, whatever is growing, you want to ensure that it is providing you the best possible results for you. And therefore, by investing, you can keep up with the inflation, but you can also improve your standard of living. And that is critical. Also, when you're investing, you can enjoy what is called the power of compounding. And we will illustrate that in the next slide. So Albert Einstein has said that compound interest is the eighth wonder of the world. He who understands it earns it. He who does not pays it. And so it pays to understand what is compound interest. By the way, for this class or for this group of students, I'm very confident that all of you understand power of compounding. So I will just go through it quickly. So the future value of any amount that you're investing is the amount invested times 1 plus R, where R is the rate of compounding, to the power of N, where N is the years over which you are compounding. So many people focus too much on the amount invested, the P, but I submit to you that it is the rate of compounding and the period over which you compound, which can have an even bigger impact on what you end up with in terms of the value of your money.
Rajeev, sorry to stop you. We can't see your slide about compounding.
Oh, you can't?
Yeah.
Okay, so what I will do, okay, thanks for pointing that out. Let me actually just stop. Let me share the whole screen actually, because maybe that will allow me to stop share, and then I will share the whole desktop, because that may ensure. Are you able to see now?
Yes, we can see it.
Okay. By the way, earlier, were you seeing the full screen, or were you only seeing in the PowerPoint?
It was in the PowerPoint.
Oh, yeah, I actually realized much later that. Okay, but now you're able to see the full screen.
Yes, absolutely.
Okay. Since when have you not been seeing the slides? Should I continue from here, or do you want me to go back?
No, you can continue from here. We could see the previous ones, the Warren Buffett quotes and the investment definition.
Okay. So I think compound interest, I will move on from here, just illustrate, because okay, so now the power of compounding is illustrated with a simple example here. And this is that if we take $1,000 of investments and you see how it is compounding through a simple interest or through a compound interest, you will see that a simple interest does not really cut it. Even if you are having a simple interest of 13%, that does not do as well as a compound interest of 7% over a long period, right? But even more important, if you just look at how the numbers stack up, if you are starting with $1,000, after 10 years, a 7% will give you around the double of your money, and a 13% will give you around 3.5 times, right? If I do the same thing after 30 years, your $1,000 have become $7,600, which is a 7.5 times, versus if you're compounding at 13%, which is a 39 times. So the point I'm trying to make here is both the rate of compounding, right, which is a higher rate of compounding, can give you much better results, as well as if you are continuing to compound over a long period, you can have a dramatic impact in terms of the wealth that you have created for yourself. So with that very brief introduction on investing and why compounding matters, let's now jump to the more interesting part of this presentation, which is what we do at DoorDarshi India Fund, a little bit of background about us, as well as how we then go about investing in the various opportunities. So we talked about the fund. It is a US Delaware-based fund investing in Indian equities. Now, the In my own personal capacity, I have earned a 32% annualized return in dollar terms by investing in the Indian equities. And this is over a period from 2014 to 2020. So over a 7-year period, I have been able to grow my capital 7 times, right? And these are audited returns by BDO, one of the biggest auditing firms. It's a top 10 audit firm in the world. And they have audited our rupee returns, and then we have converted them into the dollar terms because many of our investors would be interested in what we have done in dollar terms. Another caveat that I should point out that these are returns that we have achieved in the past, and there is no guarantee or certainty that these are the returns that we will achieve in the future. Another very interesting value of these returns is that they are not very correlated with the S&P 500. So they are only having a 40% correlation. So when an investor is thinking about why DoorDarshi India Fund, one of the things is not only good returns, but also the fact that we have had low correlation, which actually means that you get the benefit of diversification. Now, when I compare what I have delivered in my personal portfolio to a S&P 500 in the same 7-year period, 2014 to 2020, my personal portfolio has beaten S&P by 21%, right? And if I then compare it to Nifty 50, which is the most commonly used index for India, I have beaten that index by 23%. And these are like astounding numbers. If somebody would have told me earlier, I would have never believed it. And that is why we wanted to get it audited so that we have a third-party view of the returns. And we will talk a little bit more about it. So that's the background of setting up DoorDarshi India Fund. We feel that our approach works well in terms of getting great returns, but also it provides the investors, and in our case, the investors are going to be the non-resident Indians or non-Indians into the fund, right? And so it gives them the diversification benefit, and it helps them participate in the growth story, which is India. So I think I talked a little bit about the fund manager myself, so I'm going to skip that. A quick word on why we like India so much. As a US-based fund, we could invest anywhere, and we have decided to focus only on India. And there is a reason for it. The first reason we think is that finally, after many decades, in the 2010s, we had a stable government. This government is very driven in terms of creating regulatory reforms and is business friendly. So I'm just going to skip through this quickly so that we can come to the meat of the presentation. And the government is driving the infrastructure growth, which is going to have a multiplier effect on the economy. The second thing is the business opportunity. We live in a world where geopolitics are changing dramatically. Many companies are saying, I want to have China +1, which is creating new opportunities for companies. In the past, Indian businesses had very high cost of capital. As the cost of capital comes down, and as the taxes come down, suddenly the opportunities become much more because now your hurdle rate has come down. Opportunities like production-linked incentives, formalization of economy, all those are creating many more opportunities for the organized players. And then the demographics. You know, we have a working age population, which will be the largest in the world. And we will overtake China based on this projection at the bottom in 2030s. That is going to be a big driver. In addition, the per capita income in India right now, which is around $2,000, is as it crosses the threshold, you will start seeing a lot more demand, which will give a long runway for growth for Indian companies. Now, the next question is, India has to understand why Indian equities. And the Indian equities, because there's still a very limited participation in Indian equities. So only 14% of Indian household financial assets are invested in equities. It has risen a lot. So it used to be less than 5% in calendar year 2012, and it has now risen to 14%. But when you look at the bottom chart, where a US is more than 40%, you can clearly see that we have a long way to go. Another interesting aspect about Indian equities, we have a wide assortment of companies. So Indian stock market is a very highly skewed market. Few stocks dominate both the market cap and the volume in Indian equities. And if you look at the bottom, only the top 100 companies They contribute 77% of the volume, which is traded on the stock exchange, and 74% of the market cap, right? And so most of the big funds go into those companies, thus leaving us with another 1,500 stocks, which could be our universe that we are looking at. Besides, in India, what happens is many of the companies are started and owned by the promoters themselves. And so there is that alignment of interest with the owner operator, which does not exist in many other companies in the world. And lastly, it's a pretty lucrative asset class. Sensex has delivered 13% CAGR over 35 years. And I'm talking about this last year. So I'm not looking at the recent rally, which happened in 21. So you can see Sensex, I have said, is around 50,000. So, over the 13%, it's a pretty decent, over 35 years, it's a pretty decent return. In addition, in India, we have low capital gains tax. So we only have a 10% long-term and 15% short-term, which basically means that your after-tax returns are much better than some of the alternatives. And lastly, you have an opportunity to participate in the growth of the companies that I just talked about in my previous slide. So the last question is, okay, Indian economy or focusing on India makes sense. Focusing on Indian equities also makes sense, but why you, right? And the answer to that is that we have had a wonderful track record in my own personal capacity that I talked about. And we have beaten both the combination of indices, be it India or US, by a huge margin. And we have done that with a low correlation. So I think it makes perfect sense. Why we can achieve this track record is because of our investment process, right? And this is what the meat of the presentation is going to be. And so we follow what is called as expected return framework, right? And what it allows us to do is to go through a myriad of opportunities that might exist in the marketplace and restrict ourselves to companies that pass our filters and then invest in them. So it provides us a strong anchor, especially when the market moves are huge and many people are left like a deer in the headlight. We also have alignment of interest. I myself have a good portion of my money invested in the fund, and our fee structure is such that we are driving the alignment of interest. We want our investors to do well, and we want ourselves to do well. And that basically means that we want to make money when they are making money. And that is our business model. So with that, hopefully I have whetted your appetite for learning more about the investment approach at DoorDarshi India Fund. So we follow a value investing philosophy. And at the heart of the value investing philosophy is to buy companies with a significant margin of safety. What does margin of safety mean? It means that you're buying a company which you think is worth $1 for only 50 cents. And this is just illustration, not every time 50 cents, but that's an illustration. Now you may ask, why would it sell for 50 cents if it is worth $1? And that may happen because there are short-term demand supply situations, short-term risks that people see, and they are just too much focused on that risk. And there are many other reasons. And why are we buying at such a discount? Because we want to ensure that even when we are wrong, we don't lose a lot of money, right? And if we are right, then we can do well. So this goes contrary to what many of you would be learning in the CAPM model, the capital asset pricing model, which says higher the risk, higher the return. We think to increase the return of our holdings or of our portfolio, we need to reduce risk. And so just to give an example, if I'm buying a company which is worth $1 for 50 cents, right? And let's say it can fall to 20 cents if we are wrong, and can go to $1 if we are right, okay? So there, we can get 100% return if we are right, and we can actually have a loss of 60% if we are wrong. Now assume that instead of buying it at 50 cents, I'm buying it at 30 cents, right? What has happened? My returns have now gone from 2 times, it has become 3.3 times. While my risk, which is the loss of capital, has come down from a 60% to only 33%. So this is an example where if you buy it well, you are actually increasing the return and reducing the risk. The second aspect, sometimes people confuse value investing as only buying cheap companies. That is not how we think. We think growth is a very significant part of value. And India is a growth market. And Warren Buffett, when he was asked, do you account for growth? He said, listen, both value and growth are joined at the hip. And that is how we think. And Charlie Munger has said, all intelligent investing is value investing. The second thing that we do is we have a focused portfolio. And what that means is that we want to invest more in our best ideas. We want to know our positions better than most other people. And therefore, we are continuously doing a lot of diligence. And once we have invested in them, we are doing our maintenance diligence in ensuring that we know what is happening with those businesses. So this gives us the comfort to have that focused portfolio instead of the very diversified portfolio that some of the mutual funds might have. We have a long-term orientation because in the short term, returns may look volatile. Now, many of you would have seen what has happened during the COVID crisis. The stocks just fell vertically, right? And then over the last 1.5 years, we have been in this up move where the portfolios have just gone up and up. And now we are again seeing some volatility in the markets. What is important to realize is that over long term, it is the returns which dominate and not the volatility, right? So again, many of you would know that returns grow linearly with time, right? While the standard deviation grows with the square root of time, right? And so clearly, if you think long term, it is not the volatility which will drive your returns, which will impact you, it is your returns. And by having a long-term orientation, you can have better decision-making because you reduce the noise. We are sector and market cap agnostic. So we want to invest in companies that we understand. And we don't want to worry about what somebody is saying. It is important for us to build our own insight and to be able to invest accordingly. We also have a skin in the game, right, which I talked about earlier. So whenever we are investing, we are thinking of our investors as our partners, as somebody we want to partner for a very long time. And therefore, our investment fee is based on the performance. And by having my own net worth invested in the fund, I am ensuring that my incentives are aligned with that of my investors. When we are investing in a company, we are looking for companies which have good quality of management and good business quality. There's a famous saying, you can't do a good deal with a bad management, and that is something that we take to heart. One of the ways of filtering management is to ensure, does the management also have a skin in the company in which I am investing? And this is through insider ownership. If the company does well, the management also does well. And that is very important to us for many of our ideas. We also want to invest in companies which have high return on capital and which can continue to do well for a very long time. Sometimes we also find opportunities in special situations, and we'll talk about that. We want to benefit from the manic depressive behavior of Mr. Market. Now, Mr. Market is an allegory that Benjamin Graham gave about thinking about the stock market. So he says, listen, think of stock market as an individual who is coming to you on a daily basis saying, please buy this company from me, or please sell this company to me. And on most days, you don't have to do anything. But only when you think that the company that the stock market or Mr. Market is selling is mispriced, you can decide to either buy if you have the cash available, or decide to sell if you own the company. And that is what we are trying to do in our approach. Lastly, we want to go where we have a competitive advantage. Investing is very, very competitive. Everybody is trying to do well. And so one of the questions we have to ask continuously is, in whatever opportunity we are seeing, why do we have an advantage? And if we don't have an advantage, why do we succeed? And that is very important. If we cannot identify the other side of the thesis, as in the bear case, if we are buying, if we are a bull, if we want to buy, then I think we are on shaky grounds. So a few areas where we have found interesting opportunities for us. One is contrarian bias. We want to go where we have a variant perception. Our perception is different than that of the market. And as long as we can build enough confidence in our perception, we are happy to go and invest in that. The second thing is a smaller cap and mid cap. Now, as I mentioned, Indian stock markets are highly skewed, right? The top 100 dominates everything. And so if we are focusing on the next segment of the stock market, there's less analyst coverage, and that allows us to get into situations where others are not looking. The third area is a stronger balance sheet. Markets are very focused on earnings this quarter, this year, and so on. But if you look at the balance sheet is telling what the company has done over the last N number of years. And so if it is a strong balance sheet, it tells you that the business is possibly a good business and it is a pretty resilient business. And that is important. Now, I have laid out the approach. Let's talk a little bit about how we then execute it in real time. So our idea generation is from multiple sources. So we can have ideas either from our existing portfolio. We're always looking at competitors to the ideas that we have, and that could be a source of new ideas. It could be talking to friends, participating in various industry conferences, reading news, or reading various investment theses. So it is coming from all sorts of sources. These promising ideas go through detailed analysis. And what I mean by that is that we then spend a lot of time trying to understand the business. And this is typically done by reading annual reports, hearing the conference calls, looking at management interviews, talking to other people who may be familiar with that business or other competitors in that business. And that helps us build our comfort with any idea that we are looking at. If we are uncomfortable with the management, we will immediately reject, because we think in the context of investing in Indian equities, management comfort is paramount. If we are not comfortable with the management, it is very hard to make money. Now, filtered ideas then go through our forward return analysis, where we basically come up with our expected return over the period that we intend to hold that particular idea. Then all the ideas are stack ranked based on this forward return or expected return. And the ideas which have the highest return get more allocation. And the ideas which have the lowest return, which are in our portfolio, they would be on our sell list as we need to raise more cash. So this forward return analysis is a continuous ongoing process. And it is dependent as new information becomes available, we try to incorporate that. Also, on a daily basis, the price is moving, and that impacts the forward return. So we are on an ongoing basis evaluating how the forward return of our portfolio companies is changing, as well as our watch list companies, which is in our watch list. And then cash is a residual to take advantage of the opportunities. So if we are not finding good opportunities, we will be in cash. We're happy to be in cash. And as we have opportunities, we will deploy. And as we don't have opportunities, cash will build in the portfolio. Now, interestingly enough, this investment process and this investment approach that I'm sharing is something that I presented way back in 2017. And any of you who would have an interest, I'm happy to share this presentation where you can actually spend a lot of time understanding how we have looked at some of these ideas using this process. Now, let me just do a quick time check. How are we doing with time? Okay, 8:37. So maybe I will spend another 5 minutes. So I'm going to skip a few slides because I think I don't want to keep you forever here. I can keep talking about investing forever. But quickly, DoorDarshi India Fund portfolio strategy. We are a long-term Indian equities focused fund. We don't use derivatives other than for hedging purposes, and that too very infrequently. The number of stocks in our fund is 10 to 35. As I mentioned, we are a market cap agnostic fund. When we're allocating money to any idea, we want to have a soft limit of 10% and a hard limit of 20%. What that means is beyond 10% of the money at cost, we want to be very careful of deploying more money in that idea, except if that is the best idea by far that we are seeing, then we're happy to go further. And there's a hard limit of 20%, which means you'll never ever go over 20% in terms of the cost. Risk management is a fundamental way to invest. Too many people focus only on the return and not focus on the risk. And as I mentioned in my experience, I have been in the risk area for more than a decade. So I know what Wall Street does, but the risk that I have managed there was much more on the trading side. So what I have done there versus what I do now is very, very different. So in investing, how we manage risk is first, do we understand the business? If we don't understand, it's not even an opportunity for us. Then we want to look at what the company and the management has done in the past, because past is a good prelude to what will happen in the future. Not necessary, but in general, it is a good indication. We want to have management incentives aligned with that of the shareholders. We want to have businesses with conservative capital structure so that they can withstand adversity like a COVID-19. We also do what is called a pre-mod, which basically means before we invest in a company, we visualize a situation where the company has not done well, let's say a year from now. And then we try to say what all can go wrong. And then we try to say, what is our probability that these things will happen with the company? Once we have done all this, we look at the valuation and look at the margin of safety and therefore our expected risk and expected return. And then we'll position size that particular company in the portfolio based on all these parameters. So in our fund, our goal is to double the money over 5 years, which is sort of a 15% return. And this is our goal, to do better than that and to beat both S&P 500 and Indian indices. I'll skip this. So I talked about various aspects of DoorDarshi's approach. Let's look at what has been the results from this approach. I briefly mentioned about being a top-ranked analyst on SumZero. So I have been presenting various case studies on SumZero since 2017. And what you will see on the left is that I have, from my various ideas that I have submitted, the returns are 68.7%, right, across various time periods, depending on how long the idea has been open. And this has beaten the benchmark by 42.3%. And this is as of December, I'm saying, so I just took the recent numbers. So you can clearly see that our research has done well in terms of the performance of those ideas, right? And that is what enables us to be a top-ranked analyst on this platform. So a few recognitions. So in December 21, I am the #1 ranked analyst in the financials category on SumZero, right? And you can see some of the ideas which have done well for us, and we will talk about them in the second part of the presentation. So IDFC Limited, IIFL Finance, Manappuram, and Manappuram I presented twice. I'm also #5 in East and South Asia, so that covers pretty much a very big portion of Asia, where I am across all categories #5. I'm #12 in growth at a reasonable price category that they have created, and #14 in small cap across all regions and across all sectors. So I think it sort of indicates that our approach is working, at least for the ideas that we have presented. The second aspect is the past returns in my personal portfolio, right? And as I mentioned, that BDO did this audit for the returns that I had in my personal portfolio. And so you can see from 2014 to 2020, I have had returns that have really varied, right? So 2014 was a banner year for me. And then 2019 was not necessarily a good year for me, right? But over time, if I look at the annualized gross return, it is 36%, right? And compounded annual growth rate is 36%. And if I then go on the right-hand side and look at what the indices have done, they have done between 11 and 15%, give or take, right? So clearly, the portfolio has done way better than what the indices have done, and shows how we have been able to do much better. Now, if I take the same returns and use the dollar INR impact, so rupee has continuously depreciated over those 7-year periods, we get what is the dollar returns. So a 36% return in rupee terms become a 32.8% return in dollar terms, right? And that accounts for the fact that rupee has depreciated. Compare that to S&P 500, which has an 11.3% return, and a Nifty 50, which has a 9.4% return. So again, this tells you the 21% that I was talking about that we have beaten S&P 500 by comes from here, and the 23% by which we have beaten Nifty 50 is also here. Last one on the returns. If somebody, if I had invested $1,000 in my portfolio at the beginning of 2014, it has become 7,289 after 7 years. So that's a 7x in 7 years, which is easy to remember. But also it is important to realize that things don't always go straight, right? 2018 to 2020 were period where the portfolio did not do as well. So investing is something, therefore, where you need to play a long game. Now, obviously, if we have succeeded so well, one of the questions we have to answer to ourselves, but also to our investors, is why do we succeed? And we think we succeed because we have a well-defined investment philosophy, investment approach, and investment process. And I just talked about that. We then have a discipline to stick to our approach, because there will be time when our approach is not working. I just demonstrated that in the previous graph. And so what do you do when your approach is not working? And if you are willing to stick to your approach, there is a possibility that you will do well. We are also choosing markets which we think can do well, and that is the Indian equity market. And I have laid out why we like Indian equity markets. But also there's an additional element, which is that Indian equity markets are swayed by many non-fundamental factors. And the non-fundamental factors are things like an election that is coming up, or FDIs turning risk on or risk off, the oil running up, and it might have a short-term impact, but over the long term, those things are not as consequential. We also partner with right investors. And when I say right investors, we want to have investors who have the same long-term orientation. If they don't have that long-term orientation, they will be looking for something different than what we are looking for. And we don't want to have mismatch of our expectations. Now, investing is a game where you have to learn continuously, because whatever you know, everybody else knows as well. And therefore, you don't have any specific advantage. And so our ability to learn will continue to differentiate us. And lastly, I have shown you how we have done well in the past. And we think this track record of success has given us the confidence to stick to our approach and continue to live with this approach. So with that, I will stop here and see if there are any questions, and happy to take those questions.
Thank you, Mr. Rajeev. That was a very clear explanation of very complex concepts. And the question I have, Mr. Rajeev, is India is currently on a bull run, right? And there are a lot of stocks which are overvalued. And you have spoken about value investing and buying a stock with a margin of safety. And there are a lot of startups which are having an IPO boom as well, like Zomato, Paytm. So how do you approach this IPOs? And the second question is, will you invest in such IPOs?
Actually, that's very interesting. I have a slide on it. Maybe IPOs, I will actually, let me go to that slide, because, this is a question that comes from time to time. And yeah, view on IPO. Okay, my view on IPO is it's probably overpriced. And that is what Warren Buffett is saying, right? So when God says something, you listen to him, right? And so I think in general, let me say why we don't like IPOs, okay? We think that the incentives are completely misaligned, okay? The person who is bringing out the IPO, which is the lead managers, right? And the sellers, they want to get the highest price, okay? Not only do they want to get the highest price, they know the business better than anybody who is coming into that business. Why? Because they are the one who have been running the business, right? So clearly they know it. So there is not only just that they want to sell at a good price, they are also very much knowledgeable, while the investor who is investing is not knowledgeable at all, right? And obviously IPOs are brought when equity markets are doing well, which is what was part of your question, right? So the timing is actually off. And lastly, if you are successful, if the IPO is successful, guess what? You hardly get any allocation, right? You see how many different IPOs which are doing 100x of the subscription that they were asking for. What will you get? So even if you put a very big amount, the amount of shares that you will get will be nothing, right? So we think that incentives are completely misaligned. And actually, I will talk about some case studies in the second portion, where I will tell you many of those companies which we later on participated in had an IPO that was a massive success. And then these guys from being a massive success, became the pariah of stock market, right? So I think the short of it is that we don't invest in IPOs. In general, it's a class we don't even worry about, right? Because IPOs can keep coming, and they will come at a time when everybody's very excited. But we think there are a lot more opportunities in the secondary markets, right? Because there is no misalignment of interest. We are buying from other investors who are selling. Sometimes it could be the management themselves, but most of the time you're buying from other investors, and they are not necessarily having any advantage. And you have a much wider set of securities to choose from. So therefore, we don't invest in IPOs. We don't even look at them. We will look at them when they become more interesting.
Thank you, Mr. Rajeev. Coming to our second question posted by our cohort is, does diversification really work? For example, we have legendary investors like Ray Dalio, Peter Lynch advocating for it, but Warren Buffett and Munger do not really advocate the diversification thing, and they say that invest on focused strategies. So do you also advocate a focused portfolio, or do you consider diversification or example?
Yeah, so I think somebody said it very smartly. He said, listen, diversification is an insurance policy against ignorance. And I think for people like Munger and Buffett, who are so intelligent, so smart, so successful, they don't have to diversify. But we mere mortals, we have to, right? And so how much you diversify depends on what is your comfort with the idea. You know, I presented my approach where I said, the more comfort we have with an idea, the more we are willing to concentrate, right? But we still have put certain limits, right? I am not going to put a 40% of my partnership assets in one company like Buffett did it, right? With American Express. So that is not something that I have that level of conviction. But one of the things which we also find is that I am not going to have 100 stocks in my portfolio. You know, Peter Lynch did it very successfully. He was possibly working 100 hours more per week, and you look at the work that he has done in his books, and you know why he was that successful, right? He had a huge amount of Fidelity resources available to him, and so possibly it worked for him. But I, in general, agree with what Munger and Buffett says, which is that you're not going to find at any given time a lot of good opportunities. At any given time, only a few opportunities will look appealing to you, and the rest will be average. And if you want to do well, you want to maximize where you have good opportunities, not go for the average opportunities, because then by definition, your returns will come down. But at the same time, I also believe that we cannot be too over-concentrated. And that is why some of the limits that we have placed on our portfolio in terms of the concentration. So I think if you look at what we said, between 10 and 35, you know, it's a pretty broad range, right? And the reason we have kept it broad is because there might be times where we are finding a lot of good ideas, maybe a few good ideas, and we just want to concentrate. And when we are finding none of the good ideas, and we are saying, well, it is not a stock picker's market per se. So we will be happy to diversify and take smaller positions in more of those average positions and then scale up as the opportunities emerge.
Thank you, Mr. Rajeev. And I think a final question, then we can go to the second half. So the third question was asked is, there are a lot of companies in India which are still privately held and they're not tapping into the public markets. So do you think going forward, there'll be a lot more companies opening and tapping into capital markets in India? Or how far are we compared to US, and when can India be on a stage where we are, you know, on par with China or US in terms of capital market access?
I think clearly we have a long way to go. If you just look at the size of the capital markets in India versus the size of the capital markets in US. China is a slightly different story in my mind. But the capital markets in US is way bigger, right? Both on the equity side, but definitely also on the debt side. I mean, you know, the amount of debt that is issued in US and the amount of liquidity that is there is just amazing, right? So I think it is going to take a while, but clearly India is moving in the right direction. You know, we are having more and more companies come out with IPOs in India. That's good because it allows investors to look at a wider basket of securities to invest in, right? In the past, the issue that we had was we did not have too many new generation companies or technology product companies coming out. And now this year, we have seen a whole swath of them coming out, right? What remains to be seen is what happens when the market goes through a correction, which it will. And how does the investors react in these companies, right? And what that does in terms of more companies coming out. But if you ask me, I think Indians in general are very entrepreneurial. I always feel that. And so they are looking to grow. They are looking to do better, right? That is ingrained in many of us, right? And so there is that opportunity that people will want to take advantage of. And therefore, the capital markets is a way to harness the opportunities that are out there, right, in the world. So I'm very confident that the capital markets will continue to grow and deepen, right? But it will take a while for us to get to our US level capital markets. And that's not bad because, as I mentioned, right now only 14% of the households are investing in Indian equities, very small percentage. And, I'm very confident. You look at the march, right, from 5% to 14% in the last 7-8 years, right? And the point is, if it can continue like that, we will be fine. And we don't have to be at US, let's say, even in a decade. We don't have to be. If we can just continue to grow, I think over time, the capital markets will be pretty deep and there will be a lot of opportunities for investors.
Sure. Thank you, Mr. Rajeev. I think you can continue with the second half of your program.
Okay, fantastic. So all great questions. Hopefully, you are able to get your questions answered. If you have anything, just feel free to ask. And then depending on whether the moderator asks or if you ask, either is good. Now let's jump into the case studies because case studies in my mind is the best way to illustrate the concepts we have talked about, right? And so these case studies are something that I've already submitted on SumZero. So these are not something I'm making up after the fact, right? And the reason I wanted to leave it that way is to ensure that many times we ourselves have a tendency of embellishing our records. I'm not trying to do that. I want to ensure that the records look exactly as it was based on our submission. Okay, so the first case study that I submitted on SumZero was in November of 2017. And this is Infinite Computer Solutions. It is IT services firm. It came out with an IPO, funnily enough, around 2010, right? And when it came out with an IPO, it had like a 30-40 times subscription. So it was a massively successful IPO. When I looked at it in 2017, the company was doing decently well with a good return on capital. The challenge that the company had was that it had not grown its profitability over the last few years. And that was because it was investing into new products. And when you invest in new products, you have the cost upfront, right? And the revenues will come subsequently. Now, many companies will actually capitalize those expenses rather than expense them. And Infinite was actually expensing those product-related expenditures, okay? And so therefore, the profitability was looking quite weak. I have laid a lot of emphasis on owner-operator management. So this was a situation where the owner-operator, Sanjay Govil, was owning 75%. And he was the chairman, executive chairman. And Upinder Jutsi, who was a CEO, was owning 3-4%. So it was quite obvious to us that there is an alignment of interest, right? So I recommended this in 2017, November, as I said. It was around 260s in that range. And as it happened, and we thought it can easily double from there in the next few years, or it could be bought at somewhere like 50% plus upside from there at a current price, right? And it seemed like management agreed with us, our promoter agreed with us. In January of 2018, they announced the decision to take the company private, right? So we actually got a 75% return in this particular opportunity within 6 months. And by the way, prior to that, the company has been doing buybacks, but the market was just not responding because there was no earnings growth in this particular case study. The second one is Jammu Kashmir Bank. Now, this is one of the worst ideas that we have had on SumZero. So many of you might be aware of this bank. It dominates banking in Jammu and Kashmir with more than a 50% market share, both in credit market as well as in the deposit market. They have extensive presence in the Union Territory of Jammu and Kashmir as well as Ladakh. And because of that, they have a low cost of deposit. So when we looked at it in 2018, we found that the bank is a dominant bank. It has a lot of advantages, but it was going through a challenging period in terms of its credit book. And we thought it will take a few quarters, maybe a few years maximum for that to sort out. Unfortunately, that was not the case. We were wrong. And so the position was closed in December of 2019, where we took a loss of 48%, let's say 50% in 21 months. So this is the absolute worst sort of idea that we presented on SumZero. And then when we reflect and we said, what went wrong? Why did we do so poorly in this case? It was quite clear that the management had no incentive of doing well. They were focusing on being in their seats, right? Not necessarily trying to make good credit decisions, not trying to grow the stock and the business. So this was a case of misaligned incentives. And these misaligned incentives translated into a poor culture at the bank. And the management has no skin in the game, clearly, right? Because the management did not own any portion of the bank. And because of that, they were making poor credit decisions. Now, one more way that we grade ourselves is we said, listen, let's close it in December of 2019. And around that, it was around 30 odd rupees. And now we are sitting in December of 2021. So over the last 2 years, what has happened to this particular case study, right? Assuming if we had not made the sell decision, how would we have done? And effectively, the price is around that, between 35 and 40. So it hasn't really done much. And so while the buy decision was a bad decision, I think the sell decision did work out to be a very good decision, because frankly, our assessment that this particular company will not do much did turn out to be correct. The third case study is Manappuram Finance. So Manappuram is the second largest gold finance company. So for those of you who don't know gold finance, what happens is that the borrower deposits gold jewelry with the lender, and then the lender gives out money to the borrower. If the borrower does not return the money, then the lender can take the gold jewelry and auction it. And so it makes the collateral very easy to be monetized. And therefore, the credit risk in such books is very low, right? Manappuram Finance also went into a few additional businesses so as not to be just a one-trick pony. When we looked at it in 2018, it was a high return on capital business. Gold finance has a long runway. So when you look at it, only 40% of the gold finance market is currently organized. The rest 60% is currently owned by the local money lenders, right? What you have in villages and towns. And so as organized players keep taking away the market, we believe that Manappuram can continue to have more and more opportunities to increase its market share and increase the pie to which it is lending. At that point, when we looked in 2018, it was also a compelling valuation. It is run by an owner-operator, right? VP Nandkumar owns 35% of the company now. He's pretty passionate. He has been running this business since 1992. And Manappuram actually got listed in 1995. And when we looked in 2018, from 1995 to 2018, it has delivered more than a 25% CAGR, right? In that very long period. So it was having a great track record of value creation. So we looked at it in September of 2018. We thought it can double in a few years. And that happened within a year, right? In 13 months, it almost doubled, more than doubled actually. And at that point, we thought it is fairly valued. And so we closed the position. Then recently, we were again looking at it. And in May 21, it felt compelling enough again for us to restart the position or restart. And so we put in another case study on SumZero of why we like Manappuram. Since we have put in our case study in May, it hasn't done much. It has gone up and down, as you can see. But that's part of what happens with any idea. Now, one caveat I will just lay out for the participants. None of this is investment advice. Okay, we are not here to say that you should buy this or you should sell this, because that is not what the intention of these case studies is. The intention here is to show how we have applied our investment approach in real life and how we have looked at various companies and various case studies, which we have presented on SumZero. So it is available in public domain, and therefore I'm very happy to share with the audience today as well. Okay, so the next case study is JM Financial. JM Financial was started by Nimesh Kampani. He is one of the torch bearers of mergers and acquisitions industry in India, right? He started with this firm, and now JM Financial is an integrated financial services firm with a great track record of growth. It has multiple lines of business. It is investment banking, wealth management, asset reconstruction, brokerage, lending. So there are multiple different lines of business, and it has done well in the past. Again, owned by an owner operator with a good standing in the industry. And when you talk to people, they will say, no, the Kampani family is a good family, trustworthy, and so on. JM Financial also had a partnership with Morgan Stanley in the early 2000s, and that lasted for around 10 years. At that point, Morgan Stanley decided to have its own operations in India. So when we looked at it, it looked good returns on capital, compelling valuation. And we, at that point, got in March of 2019. However, we closed the position in October of 2019 with a loss of 21% or 22%, because at that point, we were seeing a lot more better opportunities available in the market as compared to JM Financial, right? So we closed not because our thesis was wrong, but because we felt we can do better than what a JM Financial can do over the next few years. Now, when we look at it again today, because we always want to go back and say, how did we do versus what were we thinking? In November or October of 2019, it was around 75. Today, again, it is around 75. So again, it was a good decision to get out of it, even though we had to take pain of having some loss in this particular position. Okay, next one, IIFL Finance. So this is IIFL Finance is started by Nirmal Jain and R. Venkatraman. They are the first generation entrepreneurs. And again, it is an owner-operator company. Nirmal Jain with R. Venkatraman owns more than 25%. We also have some renowned investors like Prem Vasa's Fairfax invested in the company. Also CDC invested. And when we looked at it in 2019, there were quite a few macro challenges that were going on in the world. One was that ILFNS has become from a AAA rated entity to a default, which happened in 2018. And after that, the liquidity dried up for many of these NBFCs. In addition, IIFL Finance earlier used to be called IIFL Holdings. And in 2019, they broke the company into 3 entities. So one was IIFL Finance, another was Wealth, another was Securities. And we were focusing on the finance business. And so what happened was, because of this demerger, a company that was more than 10,000 crores market cap suddenly became less than 4,000 crores. And so many big investors had to get out of this particular opportunity. So we presented in 2019, September, and so far it has done pretty well for us, around 2.8 times in the last 26 months. The one thing I forgot to mention is that if the title is in green, that means that the case is obviously still open, as you can also see from the chart at the bottom. The next one is Indostar Capital Finance. I think you would have noticed a trend here. And the trend is that many of my case studies are in the financial domain. And the reason for that is because that is where we found a lot more opportunities. And we found those opportunities because, as I mentioned, there was a macro event, which was ILFNS. And suddenly many of these financial companies were beaten up badly. And so we found a lot of good opportunities in this space. And that is why we focused on that, right? So Indostar is a well-capitalized NBFC, right? It was promoted by a private equity, Everstone Capital. R. Sridhar is currently running this company, and he was earlier the managing director of Shriram Transport. And the company was moving from a wholesale lending model to a retail lending model, right? And we thought that's an interesting segment because they're going after the unmet credit need segment of the society. Again, it was impacted for the same reason that IIFL Finance was impacted, other than the corporate restructuring. So it was available at a compelling valuation to us. And we thought, again, it can do reasonably well over a few years. As it turned out, it did more than reasonably well in 3 months. And at that point, we thought, this is good enough. We don't really need to continue with it. So we closed the position within 3 months after having gotten 67% return. The next case study is KRBL. So KRBL is the largest basmati rice player in India. Basmati rice, if you were to spend any time on it, is a very interesting industry where the suppliers of basmati rice are these farmers, and these farmers have to sell their produce at the end of the produce season. And KRBL is the biggest buyer because obviously it's the biggest player. So they are consolidating the supply from these small farmers, and therefore they have a buying power, right? Because farmers cannot hold on to the paddy for a long period of time. They then also put the paddy for a little while so that it becomes better. There is better aroma. There is the grain elongation if you put it and season the paddy, right? So we felt that this company is a market leader, but we also felt this company had good growth opportunity in its business. It again is an owner-operator, right? So I think you would have seen the trend of an owner-operator management team. And the team is highly passionate about the business. Just as we are very passionate about investing, these guys are very passionate about basmati rice player, run by 3 brothers. All of them are in the 60s or 70s, right? And the next generation is also now part of the business. They're also running it. And we like to see that. We want to see that the management is running the business for the long term, not for the short term, right? It had good return on capital, nothing great, but good. And we felt that basmati rice can continue to grow. So to just give you some stats, in India, there's like 2.5 million tons of paddy, of basmati rice that is sold, of which only 1 million ton is branded, right? So only 40% is branded and 60% is unbranded. And so there is an opportunity for KRBL, which owns around 35% of the branded segment, 35 to 40 in that range, to go after and take market share in both in the branded, but also go after the 60% of the market, which is unbranded. So there seems to us a decent runway for growth here. The company is having some issues, right? One of them is that they have a tax demand from the tax department, and they also have a query from the enforcement directorate. So I think there are some headwinds, and we'll see how that plays out. When we presented in April of 2020, as you can see, the stock had fallen dramatically. We were not very sure what exactly is going on, but later on we realized it happened because one of the big owners of the company actually had a margin call, right? So he had to sell his shares, and given the demand supply, the stock just fell. And since our initial case study, it has done around 64% in the last 19 months. And clearly, some of these prices have moved around in the last few days, so we are ignoring that. The next case study is IDFC Limited. Now, this is a case study which is a special situation, right? Where we thought when we presented it that the sum of the parts is many multiples of the price at which we presented it, right? And so we also thought that there's a short-term trigger which is out there in a few quarters, which will help unlock the value. So just to give you a little context, IDFC at that point owned 40% of IDFC First Bank, right? And it also owned 100% of IDFC AMC, the asset management company, which has around 120,000 crores of AUM under it, okay? So when we looked at it, we felt that it should do reasonably well over time. And so we presented it in June of 2020. So far, it is up to 40% in the last 17 months for us, right? Right now, the case is open. I think the unlocking has not yet happened. We will see how quickly that happens, but clearly the market has guessed that at some point unlocking will happen, and that is why you see the significant run-up since we presented. Okay, the next case study is Saturn. So Saturn is in the business of microfinance, right? And microfinance is exactly the polar opposite of what we talked about at Manappuram. So here they are lending to people who are at the bottom of the pyramid, right? And there is no collateral. So typically, So this is a model that has come from the Grameen Bank in Bangladesh, and then many countries have adopted over time. And the idea here is that if I give loan to a group rather than to an individual, then it is the group's responsibility to repay that loan, which is called as the joint lending group. Right? So when we looked at it in 2020, in December, it was a deep value situation to us. The market was very concerned about the asset quality over the next few quarters, and we agreed with that. We thought that the asset quality is going to suffer because of the COVID crisis. Many of the bottom of the pyramid customers have been very impacted. So that was something that we fully agreed. But what we were thinking at that point was that it will do well not next year or the year after, but a few years out. Right? That is what our thesis was. And again, this is an owner-operated company run by the owner. And the owner had actually increased his stake in the company from 30% to 38% prior to us getting involved. Right? And so we presented it in December of 2020. So far, it has done around 45% in the last 12 months, early days. We will wait for it and see how it plays out over the next few years. And this is the final case study. This case study, actually, I completed quickly so that I can put it in this presentation. I wanted to give you guys the latest and the greatest that I could come up with. And so this is, again, a special situation. Okay, this is Ujjivan Financial Services Limited. And this is a special situation where Ujjivan Financial owns 83% of the bank, Ujjivan Small Finance Bank. So for those of you who might be familiar with this area, RBI allowed the MFIs like Ujjivan to start a bank, a small finance bank. And so Ujjivan started a small finance bank. They got the approval in 2015. And as part of that approval, they had to do an IPO. So Ujjivan did an IPO in 2016. It was again a successful IPO, many times subscription. They also had to list out the bank in 2019, right? So even though they own 83% of the Ujjivan Small Finance Bank, they still had to do an IPO, and so they did an IPO. And guess what? The Ujjivan Financial Bank IPO was subscribed 170 times, okay? And today, if you look at Ujjivan Small Finance Bank, it has fallen almost by 50% since its IPO. So, going back to the IPO question, IPOs come at a time when there's a lot of excitement, but who knows how things play out. So the thesis here, though, is that, this holding company discount, currently, if I buy Ujjivan Financial Services, it is available, I can buy the bank at a 39% discount. So if, let's say, Ujjivan Bank is worth $100, I can buy it for $61 today, right? And if this gap closes, then this $61 becomes $100 over the next, and we are estimating over the next 15 months, right? As the reverse merger process proceeds. And that will give us a total return of 64%, right? And that will also mean a 51% CAGR over 15 months. Now, there are lots of ifs and buts here. So I don't want you to assume that this is guaranteed. No way. I mean, nothing is guaranteed, right? In the market, anything can happen. But that is how we are currently evaluating it. And we think that there are multiple risks here. So one is that the merger process does not complete, right? That is something that we have to be very mindful of, that while RBI has given an in-principle approval, they have not said, Ujjivan, you can reverse merge. So there is that risk. There is the risk that the bank continues to have poor asset quality. So Ujjivan has been hit very hard because of the COVID crisis, and especially the second wave. And the quality of the book has deteriorated quite significantly. So that continues to possibly impact the performance. And so that is a risk which we have. But, you have to have an opinion on things, and then you accordingly come up with your thesis. And that is our thesis for Ujjivan Financial Services. So let me conclude what I've talked so far with a few things. One, I want to leave you with a few key takeaways. The first one is that investing is simple, but it is not easy. It looks very simple when I present various case studies. You'll say, of course, that was going to happen. But no, nobody knows what will happen. And you could be completely wrong, as we have proven ourselves with many, many examples through the case studies, right? But you can also be right. And the game here is to say, Can I be right more often than I'm wrong? And can I be right by a bigger magnitude than I'm wrong? And that's all what we are playing for, right? The other thing you should note about simple but not easy is that if you want to do better than indices, you have to be obsessed with it. You cannot just tinker when you have some time and hope to do well. In order to succeed in investing, there are a few important attributes that an investor needs to have. They need to have a good temperament where they're not worried too much when the market moves against them, which will happen because that is when you will have opportunities. They need to have the discipline to stick to the investment framework that they have defined for themselves. We see many investors who keep switching based on the flavor of the market. Today, one thing is hot, let me go and buy that. Tomorrow, something else is, or tomorrow, the markets are not doing well, let me get out. Unfortunately, that is not the way to make a lot of money. And many times people realize that if you don't know who you are, the stock market is a very, very expensive place to find out. The good news about investing is there are a lot of great people. We talked about Peter Lynch earlier. We talked about Ray Dalio. We talked about Buffett. I keep talking about Buffett. Buffett has given some golden rules. And one of them is about rule number one, don't lose money, right? If you're investing, always look at the downside. How much can I lose in this particular opportunity, right? And if you just focus on that and you assume that you have taken enough care that you don't lose money, then all the remaining options are all good because everything else is an upside, right? So always focus on don't lose money and don't forget rule number one. And then have a circle of competence, right? I talked so much about financials because that is where we feel we have certain advantages. We have figured out certain things that work for us. And that's why so many case studies on that. And once you realize you have a circle of competence, you have to keep working and keep growing that. But when you're investing in things you understand. And if you don't understand, don't worry if somebody else is investing and making a lot of money, because that is not an opportunity which is even available to you because you don't even understand it. So the last slide, we think having the right values create value for us. And that is very fundamental to who we are and what we are trying to do. We believe that associating with people who have the right values creates value for us, right? And so it is important for me to lay out what our values are. We want to have partnership with our investors. We want to make money with our investors rather than from them. We want to ensure that our incentives are well aligned. We want to have a long-term orientation, both with our investors. When we think of anybody coming and joining the fund, we want to ensure that they're thinking multiple years out, not few quarters out. We don't want them. And we want to do a similar thing when we are investing in companies, right? So we want to have a long-term orientation. We want to work only with good people, and we want to discourage others. There are a lot of people who want to put money in, but if we feel that they are not necessarily the right people, we are happy to not necessarily bring them into the fund. We want to raise our game by working with the best people, because when we work with the best people, we learn a lot from them, we improve, and through that, we continue to become better. We want to be different. We are not trying to be what everybody else is trying to do. So we work very hard to fight what is called as the institutional imperative, which is when somebody says X will happen, everybody jumps onto that bandwagon. And I don't know how many of you have noticed, but there was a report recently by UBS saying Indian markets are expensive, and so many other investment banks then also started saying, reduce your allocation to India. I'm not saying that's wrong. I'm just saying that herd mentality is everywhere. And lastly, continuous learning. We think that to succeed in investing, but more importantly in life, you have to learn continuously. And we are on this journey to learn and earn. And I think it's a wonderful, wonderful journey. So thank you for the patient hearing. Here are my contact details. Happy to take any questions, or if you want to subsequently contact with me, feel free to reach out on these coordinates.
Thank you. Thank you, Mr. Rajeev. It was a wonderful explanation of different case studies. And guys, please mute yourself.
They may not be aware.
I just said. So there's a question from the chat, Mr. Rajeev, from Rahul. He asks, how did you approach the investors when you wanted to raise funds from them? And how has it been changed from the time you started, and how is it different now? And the second question he asked is, how would you advise someone who want to raise money from the investors and he wants to run a fund?
Yeah, so one thing is, how did I approach investors? I actually did not approach investors. What I did was let the queries be inbound rather than outbound. And what that does is we lay out our approach. We tell people this is what we do, this is how we do it, this is what we have done. And what it does is when the queries are inbound, it allows, there's already a filtering that has happened. These people have decided they want to collaborate with us, right? And that makes it a lot more of a win-win, right? Many times in the fund management business, people are trying to raise the most money in the fastest possible time and become the biggest AUM. We are not trying to do that. We are far from it. And the reason for that is we want to have patient capital. We want to take advantage of the opportunities that the market throws at us. And we can only do that if we are long-term oriented, right? So the capital that has come in is typically from people who know us well, who have had the opportunity to know us over many years, or who have had the opportunity to look at what we do, why we do it, and therefore they build their own conviction, right? We are not in the business of selling. We are in the business of trying to produce good returns. And as somebody has said, if you produce good returns, people will even find you if you are sitting on a small boat in the middle of the Atlantic Ocean, right? Because everybody's just trying to make money. So the point is not to go out there and say, listen, give me money, because nobody will give you money then, right? The point is to do your job. Charlie Munger has said, the best way to get a new client is to do the best job of that is in front of you, and new clients will come to you. And definitely having the right orientation and finding good people is absolutely critical, right? For somebody like me, I don't really need to take anybody's money. I'm comfortable just managing my money. But the reason we go and have a fund is because this is how we build and bring good people in our ecosystem. We want to ensure that we are working with people who are the best in class, from whom we can learn and who benefit from what we bring to the table. So it has to be a win-win. If it is not a win-win, it's not good enough.
Thank you, Mr. Rajeev. I think, Rahul, that answers your question. Praveen, you can go ahead with the question. Unmute yourself and please ask the question.
Hey, thanks, Anand. Hey, I have a question. I have actually a couple of questions. I'll go first. The main one, which I'm just looking. So this is related to the management analysis. Okay. So most of the times, this is where the information we cannot able to get accurately in the annual reports and all. And while we are doing the analysis, one of the things people will always look on it, how much the management is drawing the salary. Okay, if they said, okay, if he's drawing the salary more, people will say, no, okay, the management is not good, and the analysts are raising the red flag. But on the flip side, that's what we talk. If the management is not getting enough salary, if they are not getting motivated, they'll not think about generating the wealth of the company. So what your view on this, taking the management analysis on this parameter?
I think it's a fair point to look at. You definitely want to have management incentives aligned with that of the shareholders, right? And if they're taking a very high salary, you have to look at that salary in the context of the profitability of the company, right? And many times you see management which are too greedy, right? And sometimes they may not be greedy. That is how they want to say, listen, I am contributing enough, and therefore I want to draw a high salary. So I think salary is one of the parameters, right? But you should look at what has the management done over time, and how has either they have built out the company, built out the value for the shareholders, build out the marketplace positioning, right? All of those are very important. And then you say, fine, have they done well? Fine. How much have they taken for what they have done? And if they are only taking salary and not contributing, then obviously that's a red flag, right? That's easy. And if they have done very well and they're taking a lot of money and you think that is justified given what they've contributed, that's fine as well, right? So it's a question of when it falls in that gray area between the two extremes. And there it is going to be your judgment of what you feel they have added versus what they are taking, right? And to your point, It is absolutely important for management to earn enough, right? If they don't earn enough, why are they doing it, right? But at the same time, that should not be at the cost of the shareholders. And that is what you should always be thinking. And again, these type of analysis can never be done on 1 year or 2 years. I think one has to think over many years before you can derive any conclusion on whether they are taking too much or too little or just right.
Thanks, Raju. That's help. The another question. This is related to the current context. So recently, the Times Group has done some analysis. They said the number of small savings accounts got shrinking and jump in the mutual fund portfolio. So it means most of the Indians are now entering into the mutual fund portfolios. But at the same time, if you hear about from the last 1 year, okay, lots of the young people are moving into the crypto, right? So what do you see? Because even though we feel that okay, now the retail investment participation is increasing in India, but suddenly this another asset class, I don't know, still people are saying as an asset class, but people are moving into and behind on the crypto. So what's your view on this?
What's my view on crypto, right?
Yeah, do we still go behind the crypto, or no, the traditional one is good?
Yeah. So, there are many things that will happen in the market, and we don't need to have a view on crypto. My personal opinion is something I don't understand, right? Crypto is something that I don't understand. I see a lot of excitement about it. I do also hear a lot of questions around it, which is interesting, which tells you the excitement, right? And my view is I don't understand it enough, right? If you ask me at a very high level, if I am running India, right, do I want a competitor to Indian rupee as a currency in India, right? Which means that I am RBI, right? Do I want RBI to give up its power on the currency that they will circulate, which is in rupees, right? I think none of the sovereigns would want that, because that takes away the power to stimulate the economy or reduce the excitement that is there, right? So there will be a way possibly for people to figure out how you can reduce, you can have some sort of coexistence, but I am not a big believer in crypto the way it is done now. Obviously, a lot of people talk about metaverse and NFTs, and that is where crypto will be huge. And all that is possible. All I'm just saying is I just don't know enough to have an informed judgment. And so I'm not going to play something which I don't understand. Right. I think you're muted. I can't hear you.
You're muted.
Yeah, that sounds. I think that's what you are. The philosophy also. If you don't understand, you will not invest it.
Yeah.
Thank you.
Kishore, please go ahead with the question.
Hi, Rajeev. Thank you so much. I have a small question about this. Of late, I came to know about these black swan events. What is your opinion, and how the fund managers factor these events into their calculations?
Right. So, the definition of black swan is something unexpected, right? So as soon as you say black swan, this is not something that was expected. And that is why it's a black swan, because you expect white swans and suddenly a black swan shows up, right? Now, the only thing is that when you have a black swan, what you are basically saying is this is unexpected. And so how you are preparing your portfolio is not when the black swan event shows up. That is something that you have been preparing for all along. And then when a black swan event shows up, how does your portfolio perform given the event, right? Now, let's look at, for example, COVID, right? It is a black swan. Nobody expected it. And so nobody could have prepared for it, right? And so if you cannot prepare for that particular event, what could you do? And that is where we always ask our companies to have low debt, enough resiliency in their system that they are not going to be impacted so massively that they're taken out of the game. There is a famous saying, to finish first, you have to first finish, right? And if somebody is putting too much capital, too much leverage in their company, that is a risk to us. It's a big risk, right? Because we don't want that tomorrow a big event happens and now they cannot perform, right? And a lot of my case studies are actually financials, right? And financials are at the biggest risk for a black swan. clearly, because they're levered entities, right? And so one has to be thinking continuously, do they have enough resilience? Does the management have enough skin in the game? How are they thinking about ensuring that if something were to happen, they will be able to manage through it? And everything that we have talked about has done well. The one place where we did not is JK Bank, right? And so I think my point is you need to think about resiliency, and black swan or no black swan, your portfolio should be able to do reasonably well over time.
Thank you, Rajiv.
Sure.
Yeah. Vinu, please go ahead with the question.
Sure. Hello, Mr. Rajiv. Just a question about like on a day-to-day basis, to what extent is the potential stock discovery done at your place, and what to what extent is it automated, or do you have some software or some in-house IP that helps you make such discoveries, and at what point do you make a decision to let go of your holding in a particular stock? What goes into that? What level of complexity is involved?
Yeah, so I mean, I think that is where I think start with the definition of investing. When you're investing, you're trying to find situations where you have a good expected return, right? Now, good expected returns means basically understanding the business and seeing what you think is probable, right? You could be completely wrong. Whenever you are investing in any situation, whenever we are looking at any situation, we can never be confident we are right. All we know is, given the facts, seems interesting, but we could be completely off base, right? So first thing is to be very mindful that you are wrong. And then act as if you could be wrong, which is the pre-mortem and everything else comes in, and position sizing and everything else comes in, right? So that is what is our mindset, that we could always be wrong. We should always be prepared for that. The second thing you asked about IP, clearly we have our own framework, right? That framework works well for us. That is something that we have built over time. And that framework allows us to go through all these various opportunities that are presented to us. So that is an IP, because if you don't have an IP, why should you do well? It's very obvious, right? So you need to have an IP to do well. But that IP is something that you build over time, and that is how you differentiate yourself from everybody else who is trying to do well in the market, clearly, right? And so I think you need to, and again, you cannot have an IP. And that is why I was saying earlier that investing is very personal, right? Everybody thinks of the same approach very differently. I will give you an interesting anecdote, right? In the fund management business, right? So we are in March of 2020. COVID has just hit us, and so has hit the stock market hard, right? It was a vertical decline, right? Every day you are waking up and you have a 5% decline or something, right? And it's like, what the hell is going on, right? And I'm talking to a few fund managers out there, and they're saying, you know what, Rajiv, this looks too bad. I'm just, I was already having a premonition. Okay, so they had a premonition. Oh, I'm 20% in cash, but I'm increasing it to 40%. I'm like, okay. And on the other hand, when I am looking at it, I'm like, things are becoming really compelling. And I'm not looking in 21. I'm not even possibly looking in 22. I'm looking at 23. And I'm saying, yeah, COVID is there. 21 looks, or 20 looks bad. 21 looks bad, possibly. But 22 should be all right. And again, nobody knows. I don't know whether 22 looks all right or not. But having that long-term orientation gave us the comfort to say, no, yeah, COVID is bad. But our thesis is not based on what happens in 20 or even in 21. And when you're looking at the value of a company, right, how much is the earnings of 20 or 21 going to contribute to the overall value of the company? It's not a very big amount if the company is going to last for a long term, and it may not. So that's the biggest risk. Can the company go under because of this event, right? And if not, I think we can actually be comfortable investing, and therefore having the right orientation, right, is so critical. And being very mindful that you could be wrong, because one thing we know about investing is we will never get all our ideas right. Nobody bets 100, including Warren. So I think that's how it is.
Yes, thank you, sir.
Rajeev, please go ahead.
At the outset, sir, very, very thank you for such an insightful session. Just a small question regarding the IDFC slide that we had. So you were talking about some of the parts. So, sir, in India, what we are seeing for the past so many years that I mean, lots of companies are there where we are saying, or we are listening to people saying that the sum of parts is greater than the whole company right now. So spin-offs would be better. Leading example being ITC. So how do we, apart from fundamentals, how do we identify that sum of the parts is basically greater than the company as a whole as of now? So is there any specific formulation, or how fundamentally do we judge that?
Can I just quickly ask, which company did you refer to?
The IDFC.
No,
In
IDFC
your
is fine, but
slides.
you also said you give some
Leading
examples.
example, yeah, leading example being ITC in India. I mean, lots of
ITC.
13 major business lines and spin-offs
Yeah.
on the call. We were listening all the time. There's a news, after quarterly earnings, we hear that something or some business line is going to be spun off. So how do we identify whether this is going to be a value creative kind of thing?
Right. So IDFC getting to the sum of the parts is pretty easy, right? Because IDFC, as I said, owned 40% of the bank and owned AMC, right? The bank is a listed bank, so you can look at what the value, what the 40% stake of will be worth, right? AMC, what you can do is look at what is the private, valuation of such a AMC, because you would have seen some private transactions that would have happened, right? And then you can come up with the valuation of it, right? Now, the question, which I think you are alluding to, is the fact that, listen, there are so many holding companies and the discount that is there always continues. It never ends. So why is it that you felt that in IDFC, the discount will come down, right? I think that's basically what if I understood, that's the gist of your question.
Absolutely, sir.
Yeah. So I think the reason is because we expected that RBI will give them the permission to reduce their stake in IDFC First Bank after October of 2020, right? So if you were to read the thesis on IDFC, that is what was the trigger point. So there was a trigger. And in addition, we have seen from management behavior in the past that they have always been talking about reducing this holding company risk, right? So many times in many of these holding companies, management does not want to remove that holding company. They have no interest. And so those are value traps. I agree with you. Because in those cases, yes, there is a lot of value, but if they're not going to unlock it, why will you do any better, right? And if you're not going to do better, why are you investing, right? But in the case of IDFC, the management has been talking about it. I also think that they have taken way longer than what we were anticipating. Okay, but the fact is that there were triggers, and in these type of situations, you want to see tangible evidence, because just having a discount is not good enough. Unlocking of the discount is as important as having a discount, right? And that's basically the thesis there.
Sure, sir. Thank you. That answers my question. Thank you, sir. Very good explanation, sir. Thank you.
Rashi, please go ahead.
Hello. Hi, Rajeev. I'm really sorry I can't go on video, but I'll just ask my question very quickly. So we often see these pretty small hidden gems like Heikel. Okay, I'm just naming a couple of them. Like Heikel was there. Then there was Jindal Poly Investment Finance recently. These guys have been multi-baggers for in the past 1 year, 2 years itself. But how do you actually understand or identify these as individual investors? Because, when you're researching, you will only find out like the bigger ones, right? I mean, I'm really sorry, this is a very personal sort of a understanding question, but I just wanted to understand, how does one identify these multi-baggers?
Right. So first thing is, you basically decide what the filters are, right? So you can say, I want to identify multi-bagger. So I want something like, let's say, a double in 3 years. Okay, so that means you want to get a 26% return every year. That's your minimum, right? If you don't get that, you're not interested, let's say. Okay, so that's the first. So what you have to say is, what do I want? Where do I think I will find those? And then go and explore in that area, right? So, but what happens and what we find many times people do is they say, oh, Jindal Poly has done. And I got 2, but the third name I did not get. I think you mentioned, but anyway, not required. But the point is—
No, I only mentioned 2.
Oh, you mentioned 2. Okay, good. So I got those 2 names then. But the idea is that, you only know multi-baggers in hindsight. Nobody tells you multi-baggers for the foresight, what will happen in the future. And that is the challenge of the game. And that is the interesting part of the game, right? You're always looking for those opportunities. What I will say is that if you are looking for multi-baggers, it's likely to exist more in the small cap space, simply because not enough people are looking at that space. But at the same time, it is also a very risky segment. Okay. And so this is where you can say that risk and reward are related. But if you understand certain companies well, right, and you have a lot of confidence that, listen, I have done a lot of work, I know the management, I feel like they will do the right thing, then that risk has come down. So it's more about how much work have you done? How confident are you with your thesis? What is your expectation? And then how big is your allocation to that? All of that will help drive the returns. Many times people will talk about multi-baggers and they will have a 1% allocation to it. Makes no sense. Like 1% has become 2%, but that's not going to be a big move to your portfolio unless you have done the work, build the confidence, and then taken a meaningful position in that particular idea. So I will say in your personal portfolio, you should think both in terms of the opportunity and then how much you want to allocate to that opportunity, right? Because if you can allocate a meaningful amount, you can do well. And that is important.
Yeah, I agree. Thank you so much, Rajeev. That was very helpful.
Sure. Rajeev will take a last question from Ashwin, and then we can close the session. Ashwin, please go ahead.
Thanks for the session.
Can't hear you.
Ashwin, you're on mute.
Yeah, I just unmuted it. Am I audible now?
Yeah.
Yeah. It was a great session, Rajeev, and thanks for insightful comments. So my question is, as a fund, you would be receiving investments from your shareholders very often on a periodic basis. So how do you manage the focused portfolio going with this investment philosophy, such as buying $1 worth of stock for 50 cents? So, and what percentage of your portfolio would you be willing to maintain in cash at any point in time?
Right. So, as you mentioned, cash for us is the residual, right? We don't think cash as a position, right? So, when cash comes into the fund, what we are trying to see is what are the opportunities we have, right? And I laid out our framework, how we think about it. So that helps us assess how we should allocate the cash, right? If we don't find a good use of the cash, then we will leave it in the fund as is, right? But it's not like we will say, no, we need to always have 10% position in the cash. That is not what we are trying to do. Because, if you do that, and let's say you have kept 10% pre-COVID and you have kept 10% after COVID has hit, then you're not taking advantage of the opportunity that exists in the market, right? One of our goals of investing is to do well. And you can only do well if you take advantage of the opportunities that market gives you, right? And so we always think of cash as a residual, as something which will be in the fund if we don't find enough good opportunities. Now, one thing we do is that we suppose today $100 comes in. We are not going to put tomorrow the whole $100 in a new position. If we are building a new position, we will build it gradually. Because one of the things we have found is the confidence in a position comes over time, right? If I'm having an existing position, right, I'm fairly familiar with the company, I've been tracking for many years, then I have a lot more conviction in it and I can move much faster. But if it is a new position, we will build it gradually because we want to see that our thesis is playing out. Management is acting the way we expect them to act, right? And the whole thing is coming together. So that is how we build positions. And similarly, on the selling side, we will do a similar thing. If the position is no more as appealing, we will start selling them. And so cash, again, is not because I want to build cash. It is because the position is no more as interesting as it was when we got into it. And it could be because we are wrong. It could be because the price has gone up. It could be for any number of reasons, right? But cash is not thought of as a position in the fund. It is thought of as a residual after we have made the investment decisions.
Thank you, Rajeev.
Thanks, Rajeev, for the wonderful session. And I would like now ask Rachi to give a thank you note. Yeah.
Thank you so much for this insightful session. Your words of wisdom will really are really inspiring and will go a long way for all of us who are finance enthusiasts here. So personally, for me, who takes Poor Charlie's Almanac and Intelligent Investor as Bibles, the excerpts of such books coming from a person of your stature has embedded the concepts in me. Deeply. Your personal profile, your personal growth trajectory, and over and above that 32% compounded return over a period of 7 years is phenomenal. So I'd take this opportunity to say that you would not deny us similar sessions in future, because I'm very, very sure that all of us finance enthusiasts would certainly look forward to these sessions with you in future. Thank you so much, sir, for joining us. Thank you so much for your deliberations. Thank you so much, sir.
It was wonderful. I want to just thank Kunal, Adil, and the whole team who put this together. I thoroughly enjoyed the questions. And that is what why these sessions are so much fun, because you learn new things, you are questioned on different things, and it was a lot of fun. So thank you very much.
Thank you. Yeah.
Thank you, Rajeev.
Thank
Thanks
you,
so
sir.
much.
Thank you.
Yeah.
Thank you, Kunal. Thank you, Adil. Thank you, Kishore. Good session, good questions, conducted nicely. Thank you so much, guys.
Thanks everyone. It was great to have started this. Let's take this as a
Great. Getting
Thank you.
things from
Kunal,
person of this
Rajeev,
nature was
and
really
Adil.
great.
Awesome. Awesome.
Thank you, Rashi.
Good job,
Thank
guys.
you, Rashi.
It was
Hey,
wonderful.
this was really a great session,
Thank you so
man.
much.
Thanks.
Good one, guys. You can hear me. Yeah, good job done, guys. Excellent. I think it's just the
Very good.
beginning. Amazing.
Yeah. 22nd we have a CFO coming on 22nd.
Wow.
So we should make it in person, Kunal.
No,
We should plan more in person, right? It'll be more than awesome.
Yes. It is in plan. We will invite. I am now checking his.
We can check that.
stop the.
Basically, the speaker is in Mohali. We just
He's
need
in
to arrange
Mohali, right?
this. We need to arrange his flight tickets, and we can get that up.